In January 2026, Saks Fifth Avenue went bankrupt, and it all started from a number sitting quietly on their balance sheet. Saks Global filed for Chapter 11 bankruptcy on the 13th of January 2026, but by December 2025, half of their bills were overdue by at least 90 days. Brands like Chanel were owed $136 million, money recorded on their books as accounts receivable and asset. But here's the problem, an asset. Under week 5 of our course, accounts receivable is a business's claim on the assets of another entity. It's recorded as a current asset, but only if collectible. Businesses use an aging schedule to group receivables by how overdue they are. The older the debt, the less likely you'll collect it. Therefore, Saks vendors watching invoices hit 90 days knew exactly what that meant. Using the allowance method, they would have already been estimating how much of their $136 million they'll never see. Recording bad debt expense and setting up allowance for doubtful accounts, a contra asset reducing their receivables on the balance sheet. But here's what goes deeper. When Saks actually filed for bankruptcy, vendors couldn't just estimate anymore. They had to write off these receivables entirely, removing the asset and recording bad debt expense in full. This directly reduces profit. And for small vendors already owed hundreds of thousands, this wasn't just an accounting entry, it was a threat for survival. As my notes say, a receivable is only an asset if